Hello, everyone. I'm Terence Woude, co-host of Dollars with Sense radio show and podcast, here with my fellow guru, Ella Lang.
Hi there, Terence, and hello, everyone. Thanks for joining us. Comprehensive financial planning is our passion, and helping people grow and protect their wealth is our mission. A few weeks ago, you may remember, we discussed how mutual funds make more sense. If you missed it, you can always go back to our YouTube channel and type in Ella and Terence to listen to that episode again. But the reason I bring it up before we get started here is that you should be more familiar with what mutual funds are all about, and you're ready to invest. The next step a good financial planner takes with their clients is to assess or determine what their level of risk is. How comfortable or uncomfortable is one with market fluctuations?
That's right. An essential part of investment planning includes identifying the client's needs. With goals and objectives in mind, the next step is to identify the client's risk profile, which in turn will determine a specific recommendation of funds best suited for them. We feel the best method for identifying the client's risk profile is through the use of an investment questionnaire, which incorporates two key elements: the investment time horizon, and second, the client's comfort level with investment risk. Today, Ella and I would like to share with you this scoring system, if you will, that we use for our clients before we make recommendations.
For those of you listening to our podcast, you'll be able to follow the questions on your screen and note your answers and then find out how you score at the end. And we'll show you how and what your results mean at the end. So let's jump right in with our first question, which is a pretty obvious question, but a necessary one to answer to direct your financial planner accordingly. Number one, what is the purpose for this investment portfolio? Are you saving up for retirement? Is it the intention to leave an estate for your family? Are you saving for your child's education? Is it a major purchase that you're after, like buying a home? Or are you supplementing your current income?
Yes, very important question. How you're going to spend your money is exactly what that question answers. The next question, question number 2, is around timeline. When do you expect to start making withdrawals from this plan? So when do you expect to spend your money? Is it A, in 0 to 3 years, B, 3 to 6 years, C, 6 to 10 years, or D, more than 10 years? So 0 to 3 years is considered short-term savings, also known as emergency savings. 3 to 10 years is for medium-term savings, and more than 10 years is long-term savings. So how long do you expect the withdrawals of this money to continue? A, you expect to withdraw this money from this plan as one lump sum within 3 years. So that would be your short-term money that you expect to buy a new car with, for example. B, over a period of 3 to 6 years, which means that we're not quite ready for the car yet. We're still going to look out on the market, but our old Betsy is starting to wear. So it's time for it may be time for a new car in 3 to 6 years. Over the period of 6 to 10 years, which is number C that you can choose from, or D, which is over a period of 10 years or more, which goes into mostly retirement savings. Now remember, when you retire, say at 65, you're not going to withdraw all your money all at once. It's going to happen over the rest of your lifetime. So if you retire at 65 and you pass on at the regular age that most people do, around 90 years old, you still have 25 years of investment time horizon.
That's right, Terence. We'll look at question number 4. Compared to other investors, how would you rate your own current willingness to take on investment risks? So A answers extremely low risk. B makes you a very low risk taker. C is a low risk taker. D is an average risk taker. E would require a high risk taker. F goes to very high risk taker. Or are you extremely into risk taking? And number 5, when faced with a major investment decision, Are you more focused on the possible losses or the possible gains? This kind of question answers whether your glass is half full or half empty. A will always look at the possible losses. Your answer B will be usually on the possible losses. Are you going to answer C, where you're usually looking at possible gains, or D, always focused on possible gains?
Now, when answering these questions, bear in mind there is no right or wrong answers. Whatever your instinct is probably correct. So try not to give a lot of time to think about these answers, and just go with your first impulse is, because more than often it is correct. So again, no wrong answers. The world's easiest quiz. So now, question number 6 is, investments can go up or down in value, and experts often say you should be prepared to weather a downturn or a downturn in the market. By how much could the total value of your investments go down before you would begin to feel uncomfortable? Is it A, any fall would make me feel uncomfortable? B, a 10% fall? C, a 20% fall? D, a 33% fall? E, 50% fall? Or F, more than a 50% fall? To put that into a little bit of perspective, in 2008, when we had the great panic that happened in North America, markets plunged quite a bit. Moderate conservatives went down by 20%, and the very aggressives went down by close to 50%. And so when the people who you hear who lost a lot of money in 2008, those are the ones who dropped way down to 50% and decided it was too much for them and they had to pull out. So that brings us to question 7. Suppose you have $50,000 to invest and you only have 2 investment portfolio options. The anticipated values of these investment portfolios after 1 year are shown below. Which would you be more likely to select? So again, there's 2 options, option A or option B. Option A has a 70% chance of gaining $7,500, resulting in a portfolio value of $57,500. And it has a 30% chance of losing $7,500, resulting in a portfolio value of $42,500. B, which is the second choice, has a 90% chance of gaining $2,500, not quite as much, and resulting in a portfolio value of $52,500, with 10% chance of losing $2,500, equaling $47,500 portfolio value. So looking at those 2 options, both A and B, which one are you more comfortable with? 70% chance of gaining and a 30% chance of losing, or a 90% chance of gaining and a 10% chance of losing?
Question number 8. Which of the following would best describe your investment style? Are you A, conservative? B, moderately conservative? C, are you right down the middle, moderate? D, moderately aggressive? Or are you full-on E, aggressive? Next, question 9. If you had to choose between either steady income with no fluctuation or higher income with more fluctuation, which would you pick? Now, the A answer offers a definitely steady income with no fluctuation. B answers probably steady income with no fluctuation. C, you're not sure. And D, probably higher income with fluctuation, or you are focused on definitely higher income and you can handle fluctuation.
Thanks, Ella. That's great. Let's move on to number 10. With investments such as the Guaranteed Investment Certificate, otherwise known as GICs, GICs, the future dollar is guaranteed. That's what people love so much about it. Still, this may not be enough to protect the purchasing power of your money from inflation. As a matter of fact, history shows that GICs do not protect your purchasing power of your money. With mutual funds, the annual rate of return will fluctuate from year to year. So a diversified fund portfolio would be expected to produce a long-term average return that protects the purchasing power of your money, or the future value of your money. Which is more important to you, that the dollar value of your investment portfolio does not fall, or that your investment portfolio protects the purchasing power of your money relative to inflation? In other words, if you have $10,000 now, is it more important to you that that $10,000 is still worth $10,000, but in the future money, or you don't care what it's going to be worth in the future money and you just want to make sure that $10,000 is always there? Those are your two choices. A is much more important, that the dollar value does not fall. In other words, it stays at $10,000. B, somewhat important, that the dollar value does not fall. Or C, somewhat more important, that the purchasing power is protected over the long term, so that $10,000 rises with the rate of inflation. Or D, much more important, that the purchasing power is protected over the long term. That brings us to question number 11. Which of the following statements best describes your overall view of this investment portfolio? Either A, you are prepared to give up potentially higher investment returns to reduce ups and downs in the value of your investment portfolio, or B, you can tolerate moderate ups and downs, market volatility, in the value of your investment portfolio to achieve potentially higher long-term returns. Or C, if you're interested in achieving higher long-term growth from your investment portfolio and can tolerate significant ups and downs in the value of your portfolio. So is that A, B, or C for you?
The next question, number 12, will use charts actually that will match the question. So you'll see that coming up on your screen with each question as it goes. I'm giving you a hypothetical 20-year history of 3 investment portfolios. And it shows the possible return patterns of the 3 different portfolios. Now, given the variability in the returns for each portfolio, or which would you be most comfortable owning? Portfolio A is earning an average annual growth rate of 6%. In its best year, it earned 10%, but it lost money in a year, and the portfolio loss represented 3%. So that's what you can see in chart A. Portfolio B, coming up now, earned an average annual rate of 8%. That's pretty good. And in its best year, it earned 20%. But it also lost in 3 years. Its worst year was a loss of 9%. That's chart B. Moving on to chart C, that's my portfolio C, you can see there that it earned an average annual growth rate of 10%. That's the best one so far. In its best year, it earned a whopping 30%. But it also lost money in 5 years, and there, its worst year, it had a loss of 15%. So again, pretty high percent for 1 year there. Which one do you find yourself more comfortable owning? Here's our last question. Number 13. History has shown that financial markets can be volatile. Well, that we definitely saw 2 weeks ago, right? If you started with a portfolio of $50,000, which of the following losses is the most you could tolerate over the course of a year? If the market decreases 20%, your market value now drops to $40,000. B, your market decreases by 15%, and now the value of your investment is $42,500. Are you comfortable if the market decreases 10%, which brings you down to $45,000? Or if the market decreases at 5%, market value is just $47,500. There's also the answer E, where you're absolutely not comfortable with any losses in your investment portfolio. And that's okay too.
Okay, here's how to count up your scores now that we've answered all the questions. You're giving yourself the number of points depending on the letter you choose to answer your question, and count up your totals for questions 4 to 13. For those of you listening on the radio show, we suggest you refer to the podcast on YouTube. You just go to the YouTube search bar and type in Ella and Terence, and we will come up. And there you can find the episode. This one is entitled Rates of Return and Your Risk. and then you can see this podcast on our YouTube channel to see the scores on your screen. So looking at the chart that's in front of you, you can see that the first line item there is question number 4. If you chose C, then you would circle the number 3 and then bring that over to the score total as number 3. Then you go to question 5. If your answer was D, then it would be 4, and you bring that score over to the total bar. Then you do that with all questions 4 through 13, and add up all the score totals that you have, and that will give you your risk profile. The next one, so questions, depending on the answers for question 2 and 3, relating to the timeline. So you add these two scores together to find where on the results chart you fall. So for instance, question number 2, if you answered C, then you would put a 6. And if you answered for question 3, you answered C, you'd put number 3. You add those two together, and you would get 9. Then look down one more to the bottom chart gives you the answer of what your risk profile is. So for example, if you scored 4 to 5 on the time horizon, right, then on the left-hand side you can see the time horizon label, and there's 0, 1, 2 to 3, 4 to 5, and 6 plus. These are all the years of your time horizon. So if you scored 4 to 5 on your time horizon from the answers of question 2 and 3, then you belong on that line item. Then if your risk tolerance, you scored, let's say you scored 23 on your risk tolerance, then you would go into the middle column where it says 21 to 28 because you scored 23, and you would scroll down to the 4th line item because that matches your timeline horizon, and your risk tolerance, is moderate.
What does this result mean? I'm going to remind everyone that this exercise is intended to give our clients a better understanding of the type of investment portfolio that is best suited to help them achieve their investment goals. So the investment profiles range from conservative, as you see up again on that chart, conservative to aggressive. Each have characteristics that are as follows. The conservative investor, who has an allocation of 70% fixed income and 30% equity, it's recommended for the conservative investment profile, right? Which usually focuses on the income and capital stability through investment, primarily in fixed income, as I explained. It'll also provide some exposure to capital growth investments in an effort to protect the spending power of the money over time. And it would normally be expected to have a lower level of variability of returns year to year.
That's correct. And also, we'd just like to point out that we'll go into a little bit more detail later on around the difference between a fixed income and an equity. It probably will come to light as what it is as we can continue to talking, but we will explain it a little bit later on. So from a moderate conservative perspective, the allocation is 55% towards fixed income and 45% towards equity investments. The portfolio recommended is for a moderate conservative profile. Again, going back to the charts in question 12, we're looking at basically the chart of 12A, and that's what we're describing right now. So the portfolio is a balance between fixed income investments and capital growth investments. It will provide exposure to equity investments in an effort to protect the spending power of the money over time and may allow for some modest capital growth. Will have a stability due to the fixed income component, which should produce a moderate amount of income, and would normally be expected to have a relatively low level of variability of returns. In other words, less up and downs and less market volatility. Next level is moderate, where the allocation is 40% income, fixed income, and 60% equity. As you can see, the equity is beginning to crawl up as we get more and more of an aggressive style of risk profile. This moderate investment profile is balanced between capital growth investments and fixed income. It will provide some income, but will have a greater focus on exposure to equity investments to provide a moderate level of capital growth. And finally, has a mix of fixed income and equity exposure, which will normally result in a moderate level of variability or market up and downs of the portfolio returns from year over year.
And just to remind you also, the moderate will fall under that chart you were looking at earlier, question 12. The chart B would be pressed, sort of matched up with moderate. Moderate aggressive, so again, we're moving down in fixed income, 20%, and up in equity to 80%. And this portfolio is recommended again for the moderate aggressive investor, which focuses primarily on capital growth investments with a small allocation to income producing investments. This one has a long-term capital growth as its main objective. So you got a lot of time here. It'll include some fixed income investments to help moderate the volatility of returns over years, but it will be expected to experience significant short-term variability of returns. And finally, we've got aggressive, is the portfolio that has long-term capital growth as its objective. And it will be expected to experience relatively more significant short-term variability of portfolio returns from year to year. So now, if you again looked at question number 12, chart C will be the best chart that matches that aggressive portfolio.
Now, this subject couldn't be more fitting in light of the historic elections we just witnessed in the U.S. There was a lot of speculation right up to the last hours. Americans voted for their next president, but we all know what the truth is. We know who's going to be president, but no one can really know what's going to happen. Lots of experts are mystified with how to predict what is going to go on in the markets. No one can really know how the results will affect the markets, both the next day and within the next year and beyond. But if you look at the chart that's up right now, the one that says even more shocking, basically this shows the asset class returns. So as we explained in the mutual fund episode, there's different asset classes that group industries together. So you can see on the very first bar there that goes above the 12%, energy is the word that's underneath it. So energy is that asset class. And over the last 20 years, so annualized over the 20 years, from 1993 to 2013, energy has had a return of over 12% per year. These are all the different asset classes that your money can be invested in. You'll see right around the EAFE, around 3/4 of the way through the bar graph, that's where we begin to look at the fixed income side of things. So the returns for these are smaller, as you can see, but for instance, the 30-year treasury, that's considered a bond. A 5-year strip, that's considered a bond. Gold is a different asset class altogether, and that's not considered bonds. 10-year treasury, a little bit farther down the line, is a 10-year treasury, the 5-year treasury. Those are all considered fixed income. They have a guaranteed value that they're going to be paid out every year. Where everything before that is all equities, and the equities are based off how the business does. So that's basically the difference between those. You're going to notice that really on the right-hand side, fourth from the last, there's a one in red. And this is part of the point of this graph, is that the average investor between the years of 1993 and 2013 realized a return of just over 2%. And this is where the dangerous part for the do-it-yourself investors come through. If you look at the next slide, which is coming up right now, the importance of focus and discipline, this is a more simplified version of what it looks like between the equities, the fixed income, and the average investor. So the equities is the S&P 500, which is the top 500 performing businesses in the U.S., had an annualized rate of return of 8.2%. The next is the bonds, which is part of the fixed incomes, had an annualized rate of return of 6.3%. And as you can see, between the years of 1993 and 2012, the average investor made 2.3%.
So all the more reason to be sure that you understand what level of risk you are prepared to take when investing your money. What is the investment for? And how long can you expose your money to a diversified portfolio so that you can take advantage of compound growth, both within registered and non-registered accounts? Remember, a good financial planner should respect your risk profile and invest accordingly and rebalance regularly. We're going to leave you with one more chart, which we've shown to you before. You may remember it's called the value of advice, but if you're looking at it for the first time, it's coming up on your screen now. This is to show you how much better households do with their investments when they have the advice of a financial planner, and how less well they do. They'll go bars in green, how less better results they achieve if they are attempting to do their investments without the help or advice of an advisor. Pretty significant. If you look at 197,273 right in the middle there of household incomes between 55,000 to 69,000. So quite significant growth, as opposed to these people who are probably in their prime earning years and very busy with households and kids going in and out of schools and activities and jobs that take a lot of their time. They probably don't have a lot of time to allocate to investing their money and making sure it's growing properly. And look, you can tell by the results, they're only up at 29,119. So good charts, great comparison there.
Yes, thanks, Ella. So this takes us to the end of our episode here. We hope you found this information informative. Please, if you have any questions, don't hesitate to reach out to us. We'd love to get your feedback and comments on all our podcasts. You can reach us via email at twofinancialgurus@gmail.com. That's the number 2financialgurus@gmail.com. You can reach us by phone. You can call 778-879-0820. You can also reach us via our Facebook page. It's called Dollars with Sense. There you can leave a comment or a private message us if you want. And also you can listen to this and other episodes at the Dollars with Sense YouTube channel. So you just go to your YouTube search bar, type in Ella and Terence, and feel free to subscribe to it so that you get all new episodes as they come through. And by all means, please send us your comments. Again, we really love to hear your feedback. Sometimes we actually pick the really intelligent questions for our podcasts in the future.
Thanks, everybody, and certainly our team over at 98.7 The Point, who help us bring this information to you over the radio waves week after week. And to our listeners, for your time and attention. Terence and I, your financial gurus, ask you not to keep us a secret. Pass on the good word and incredible knowledge to those in your circles, as that will benefit them from these concepts and your knowledge. So on behalf of Terence and myself, have a great week, and may
your dollars and cents be with you.